Good morning, everybody. This is Teddy Keckstedt from Forex Trading Unlocked, and we're glad that you guys are here joining us on a Saturday morning for our Forex Technical Analysis Explained webinar. So just real quickly, we want to take care of some house cleaning real quick. Just to remind you that this webinar is for educational purposes only. We're just throwing our disclaimer up real quick. And also, obviously, the markets are closed also, so you can't trade anything today, even if you wanted to. Well, except for cryptocurrencies. All right, so we got that taken care of, and of course, we have the forex-trading-unlock.com website pulled up. We'll put that back to the home page. We'll be getting back to that later. And then, right now, we have our trading view chart pulled up here. So what I'm going to do real quick is I'm going to put a link here in the chat there for you. For any of you that do not have a TradingView account, you do not have to spend any money to sign up to have one. It's a great platform to use to save your analysis on and stuff like that. If you already have one, you can pull it up to the dollar index, Dixie. That's the symbol for it, and that's the chart we're going to start with today. And once again, you can use that link to open an account there. Once again, it is free. There is a paid version for the platform. If you trade, you can use TradingView also as a trading platform also for futures, stocks, and also for currencies as well, obviously. So, okay, and in fact, we have a little ad pop up there. Okay, so we have the dollar index put up here. Let's see, we got a few people here in the chat room, all right. Okay, cool. So we have the dollar index once again. Dixie is the symbol. We have the daily chart pulled up. As you can see, this week it was pretty choppy in the dollar index. There was not much action here. Now, obviously, since 2026, if you really look at it, there's not much has changed, obviously, as far as pricing from the beginning of the year to now. But what a wild ride it's been, right? We had a great rally to start the year off in the dollar index, a lot of strength. Now, of course, we did not get a rate cut out of our U.S. Fed in the last meeting, and the question is, will they cut at the next meeting, which is coming up actually very, very soon. That's in the middle of March. Right now, the consensus is pretty strong that we're not going to get a rate cut out of Chairman Powell. It was surprised that he cut back in the fall. The consensus going into this year was a lot stronger than it is now. So that's kind of weighing on the dollar index right here. So if you're going to use the dollar index, which typically is one of the best indicators for the broad base of the Forex markets. Now, you have to take into account that the euro, the pound, and the yen are the biggest components of the dollar index. Obviously, there's other major pairs as well in there, but those are the ones that have the most influence on it, and some of them also are going to be going into pretty much a range-bound, I would say, trading environment. Probably not so much in the next month or so, but as we get into the second quarter, pushing into the third quarter, we may, if the new Fed chairman for the U.S. does not make any moves. Now, we are going to talk about the ECB, the BOJ as well when we get to the U.S. dollar yen. That's something that you want to take into account. So those are fundamentals. Those are your interest rate fundamentals. So we're starting out here with the Dixie, obviously, for a trend basis. If you're going to use that as an indicator, it's probably not going to be very, very helpful over the next few months. So that's just giving you a guide on that one. Now, on a daily basis, especially like you can see how it was over the last week, as we're getting towards these Fed meetings as well, we're coming into March end. We're going to be in the last month of the first quarter with the Fed meeting in the middle of it. So I would expect that over the next week, you're probably going to get some of your best volatility. So if we're going to get any type of real move, whether it's to the upside or to the downside as far as dollar strength or weakness, it's most likely going to happen over the next week and a half. Remember, once we get towards that second week in March when we have the Fed meeting, that's probably going to cause the currency markets to get very, very tight. just for the mere fact is that the expectations are very low of a cut. Should there be a cut, obviously that would cause a very big knee-jerk reaction, I would expect. But I think the more it's gonna be more of the tone after that meeting. So, and especially because if you'll notice why we've settled into this range with the volatility that we've had, and this is what you have to really take into account for when you're getting into our FX pairs in a moment, is that because expectations are now where they're at, you're probably not going to see U.S. dollar strength getting back up to where it was towards the end of 2025. So this top is very secure. We know that obviously we're in a downtrend. Currently we're going sideways as of the last week and a half, and actually if you look at it over the month of February, which is something that we kind of probably needed to begin with. If you look at the volatility that we had in the course of just the first month and a half, the first month of the year, that was a lot of action. We had more action in just those few weeks than we had in the past few months in the dollar index. So volatility obviously shaken up. Now we're into a digestive mode, and this is something that I would take into account when it comes to as far as what's going to happen. So if you're going to get a breakout somewhere of this range here between these 2 points, that would be when I would start to say you can start to use the dollar index once again as a gauge for U.S. dollar strength, obviously to the upside, or to a weakness to the downside. Excuse me. We have one indicator up here. This is a multi-kernel regression. Is it like my favorite indicator? Not necessarily. It's just one that I actually have up here. You can see that this one pretty much confirms it stays with the longer term trend. Obviously we had been lower, we had the bounce, and now we head in this consolidation phase. This is turned green, but it's flatline. So for this one right here, once again we have this indicator that's going very flat, as well as obviously we can see the market action for the index. So let's put up another indicator here. What I like to use a lot is the MACD. And then what I like to do is I like to modify it just a little bit. I take the fast length and bump it to 13. The slow length I drop down to 21. Excuse me. Excuse me, I gotta have a little bit more juice. Just started talking to you guys this morning. Excuse me. Very dry with the heat on last night. Got a cold day in Chicagoland too, 34 degrees. I don't know where you guys are at. I know one of you guys is up in Canada, so I can't complain. It's probably colder where you're at. Alright, let's get that off. Alright, so MACD, let's change this here. Go into our settings. So for fast length, we have this at 13, 21, and then the signal length is 8 once again, with the EMA and for both the oscillator and the other one. Just want to make sure I go over that for variables. Alright, so we have the MACD. Now as you can see here, the MACD is a totally different type of indicator. Now as far as this one, you'll notice that it was on the rise here, but it's starting to flatline over where it almost wants to go into a potential maybe sell crossover. Does that mean we're going to resume the bear trend? Well, it's very possible, especially you got to think that if there is no rate cut, okay, if there's no rate cut, then odds are pretty good that as we get into March here, which is where we'll be around here, and let's say we don't get a rate cut, Chairman Powell is still going to be Fed chairman for a couple more months yet before we get into May, where the next Fed chairman is going to be in. Then there's a good chance that dollar index is going to slide down into this area right down below here. So I'm going to put a little target here. So we're making some kind of guesstimations of where are we going to be by May. Because once we have a new Fed chairman, everything's off the table here. Okay? So here's where we are, and here's where we've been. Okay, so now let's just say we get a rally to the upside. Okay? We got a breakout here. We have this downward sloping trend line here. We had our first wave here. Second wave was our reactionary wave for the downtrend. We were originally in an uptrend. Then we failed here, wave 3, that confirmed we have more than just a correction, we have a downtrend. Okay, and now we are in what would be the reaction if we are still in a bear trend. The slope here is pretty much on average just by time. We're going to obviously break through this support line right here. Does that mean we're going to fail? Not necessarily, but should the dollar index fall below this last swing low, then yeah, this target area here is a very good spot. Now, to figure out on a Fibonacci basis, which gives us a really good idea, we'll go like this. We take this swing low up to this swing high, then we come back here. Here's our 50% line. Now, this is pretty critical for where we want to figure out where the dollar index is going. So let's make this one, we'll make it this color. Alright, so that's the 0.5, and then here's the 0.618. So I'm going to get rid of the Fibonacci so it's a little clearer for you. So here was our basically potential downside area for if we come down and start to fail, if we have dollar weakness. This is going to help us with our trend for the pound and the euro, and we're going to get to in just a moment here. So here's our downside area here. This here is a good Fibonacci support band. You have 50% and 0.618. If this trend is going to be in a range trade, which is very possible. So this last big swing low here, look at where that falls. It falls right into this category here. So that's where I want you to look at. This is going to be a very dangerous zone for you for the dollar index. Here we go, rectangle. Okay, so here is our Fibonacci area right here between these two light brownish, dark yellowish kind of line, not quite gold. So here's the swing low. This falls right in there. So we're going to take this swing low here, this next day here, it was an inside day, and we're going to put that high and that low right there, because this is kind of like where you have your liquidity support zone. Okay, you can see there's a lot of trading inside this band right here. Obviously below it, that's where it was spiked. That's where the market prodded and found its last little gap before it held and found really solid support. That falls right inside that band right there. Okay, so now we're going to remove this because we don't need it anymore. We have a very solid downside area should we get below here. For the upside, okay, now here's the thing is, here's this last swing. There was a swing low for this one for the major part of our trend. Look at where we're at here. This was support, okay? Then it became resistance here on this correction. We came back down here once again. We swang up here, could not really penetrate the high by very much. We breached it slightly, but we didn't get any big rally out of it, obviously. It settled back into this consolidation phase right here. So this is a critical high right here. Does that mean if we take it out that there's a whole new bull trend? Not necessarily whatsoever, but there's a very good chance that it could come up into this area right here. So if you want to find out for this one, what's the extreme? We take this high right here, we're going to use the fib, and we go down to this low here. Now this is key here because look at where we're at. This 0.618 is right up in this area. So the next big resistance for fib would be the point. This is the last line of defense here. So this is where we're going to use, because that fits into our area right there. Let's get rid of the fib so we can see a little more. So here's our breakout line from the last swing high. This is our target here at 0.718. This comes also with this downward sloping trend line. So we're going to put this pocket, put it right over here, and then we're going to move this right into here. So here is our pretty much high-end area right in this little spot. There we go. Let's get a little bit tighter. There we go. This spot right here. So for the upside, this is where we have. To the downside, we have anywhere in this zone right here. And I would expect to, if you come down into here, be careful. Wait for a solid buy signal if you're going to get bullish, because you could see a liquidity draw right here where you'll see this low get taken out. It'll spike below this target here, come down real fast, and then boom, It'll work its way up and then come chop. It may just chop around in this range here. Remember, this will swing low to up to here to this swing high. This area here, this whole area may be the trading range for the dollar index for the next month or two to go. Okay, so enough of that. Now that we established that, we go to our Euro US dollar. All right, here we go. Now we have a clean chart. Now, remember, dollar index, we had it where the MACD was getting ready to cross over potentially for a sell signal. Here we have it where the MACD is potentially coming over to cross over for a buy signal. Okay, so now here's something also. So we're going to put a trend line here, and we're going to put this right through here. Okay, so yes, very good chance that we're going to have a buy signal with the MACD. Now remember that indicators such as the MACD are always a lagging indicator. So for those of you that don't know what a lagging indicator is, think of it like this. No matter what, you're always looking at a snapshot of the past when you're looking at a chart, but when it comes to the indicators, you're definitely behind. What it does help give you is confirmation with other indicators. So for instance, this one here, the MACD is red, where you can see the histogram here, so that means it's still bearish. But it's starting to get kind of pinkish and it's getting really close to the median line. Once it breaches this median line and turns green, that would be obviously start to show that there's a positive momentum coming in as far as that oscillator is concerned. Now this one here flattened out. It was green, then it flattened out to turn into red, and now it's slightly green right there, but you can see there's a chop. So let's take this trend line here. Let's establish this swing high. You can see that this week, just by attrition, it broke out from this downward sloping resistance line. Okay? And we have this one right here. So we have the wedge. The market was wedging, and as of Wednesday, we broke out, close. Then we went sideways, a little bit of consolidation, and then Friday here we have an inside day. So now this is kind of something you need to pay attention to. So for your intraday traders, hopefully, if you trade on the anywhere from the short time frames like the 5 minute, if you're trading 1 minute, I hope you got some really fast connectivity and you're super nimble, because odds are on most days, if you're trading that short of a time frame, I can't see how you're not losing money and getting chopped up. You need some amazing connectivity to even remotely try and trade to scalp those smaller increments. And then the 5 minute time frame up to the half hour, if you were trading that any of the last 2 days in the currency market, you can see that where it tried to push the upper boundary of the range for the week, it failed to do so, and net opening to close, there wasn't much obvious that happened Thursday. Friday, inside day, was it positive? Well, yeah, it was positive on the day, but that's not really saying very much, especially because your volatility, your average trading range for the day had decreased so much. So when you're trading, especially whether you're an intraday trader or a weekly trader or a monthly trader, be cognizant of your expectations. A lot of times when I get on the chat room with people, they're like, should I get long? Should I get short? Should I get long? Should I get short? Well, the thing is, you shouldn't always be in the market to begin with. If you're always in the market, I can tell you one thing, you're really doing it wrong. I'm just telling you, you're totally doing it wrong. So I've been trading for over 37 years. You're definitely doing it wrong if you're always in the market. So, and the whole thing is, you can always be in the market. The only way you make money is by getting out properly. So, and you need to have a plan. You need to have good money management skills. If you don't have a trading plan, like if you just approach every day looking like, let's see what the market does today and we'll figure it out as we go along, I can tell you odds are very, very good that you're going to fail in the long run. Or you may eventually become a successful trader, but you're going to lose a lot of capital that you're going to have to make back before you even start to become profitable. So that's another thing you want to avoid, especially as when you're trading FX currencies, because remember, they are derivatives. I know a lot of people that they start trading FX and don't treat it as a business for one, or have respect for the fact of what you're trading. You're trading a derivative. It's a sophisticated product. Just because you have access to it and it's easy to have a gain of entry into the industry doesn't mean that it's for everyone, or you need to treat it, like I said, as a business and not be a gambler. If you don't have a plan and you come into it every day saying, okay, I'm going to try and make this money today and see what the market gives me, well, good luck with that. Let me know how you do. Because I could advise you right off the bat and say you're doing it all wrong. So anyhow, what's the plan right now with this? So we have our market environment. So what do we know about the Euro US dollar? If you are trying to be a swing trader and trade on a daily basis, meaning that you're looking for an entry, for instance, like depending on what you do, for instance, here we had this MACD right here. So let's just say, let's go back in time a little bit. Let's close that out. We don't need that. All right, so here we had, the market was chopping around here. We had this nice trend move here. The markets, we had this indicator here, it's bullish, right? All of a sudden we get the MACD across. We have two conflicting indicators here. We have a sell signal in the MACD, the oscillator's going red. This one is staying green, okay? So this indicator, like I said before, is it my favorite one? No. Why do I have it up here? It is a good indicator for when trends truly do shift and turn. So, and especially when there's, or at least when they're getting ready to consolidate, which is what we have here. It's a flattening of this line right here. So that helps us in that department. Okay, so let's go back to this one here. We have the slide here. We have the cross. So for those of you that aren't familiar with when you have crossovers on indicators like this typically means there's a shift in trend here. You have the histogram, it went from green to red at the same simultaneously. This is a pretty solid signal for up here. So when this market topped up here with this cross, we'll throw in a little trend line right here, and then we'll go with a little vertical line right here. Here's the cross. All right, look at how that worked out. We had a trend line that was violated. You had the crossing of this indicator right here. This indicator was still bullish, so you have a divergence right there. Okay, so here this was here, so that kind of when something like that happens, we have a divergence of indicators. Usually that means that whatever trend this is, it's going to be a corrective move. It's typically not going to be a new trend move. And if you look at it, that's what this really was. This was after a big sideways chop. You had this somewhat of an uptrend to here. It finally pinnacleized here. Boom. Here this was a nice size correction right here. Now what happens, we get the crossover once again, which is right here. And you have the histograms changing. Now here it's a little bit of a delay. It doesn't come until we've already had a sizable move to the upside. Now, here's where we get into some really good things about having a plan. Okay, so one of the things I like to use are Japanese candlesticks, especially when you're looking on a longer time frame, like a daily. If you use Japanese candlesticks, some like them, some don't. Most charts are typically laid out that way. When I first started trading, this is what they looked like. They were just normal bars. In fact, they didn't even have colors. It was all black and white. So the only way you could tell was by whether you could see the close. There's the openings on the left, the close is on the right. Okay. Visually, candlesticks, even if you don't like the methodologies for the patterns, the charts are visually much easier to see and read. You can see obviously the up days versus the down days. So this down day, or this day right here, this bottom, this swing low, this here happens to be what's called a bullish engulfing line. For those of you that are not familiar with candlestick trading, a bullish engulfing line is a very strong buy signal. Does it mean that every time you have a outside day or a big day where you have a new low and a new high from the previous day's range, does that mean that it's going to be follow through and there's going to be a bottom in the market? Not necessarily. But when you have it trending down like this, where you have been trending down for 2 weeks, and then you get a signal like this, that's a big deal. So here you see you have the candlestick wave thing here. Now if you were trying, you don't want to ever just try and pick a low, but here's a good to get your on the right side of the trend for trading on an intraday basis. After a day like this, you would think that the following days you want to be looking to buy on an intraday basis, okay? As well as look on the longer term trend to, if you have, you're going to still have corrections as you're going higher. You want to trade the action, not the reaction. So that's when you look for breaks. So a day like this, when it turns red, okay, so you look at the cross didn't even happen until this fourth day right here. So you had, here's the signal, second day of follow through, look at how, and that's when you have 2 days like this, then it's not unlikely to have a day of consolidation and a pullback here, profit taking, before wham, look at this, tries to come out, doesn't break out to the upside above the swing high, then the following day, boom, and closes above it. So here, obviously, taking out this high, we know that we have a swing low, this upside trend is in place. So here we have this trend. Now look at, what does this remind you of? Remember the dollar index that we just looked at? Okay, it's in reverse. Why is that? Do they always look the same? Not necessarily on a daily basis, but there will be a lot of similarities because the euro has the biggest weight. And with the euro going sideways especially, now here's the thing is, what's the expectations for the ECB? We're getting into that now. So we've laid out some fundamentals, we got some technicals, we're about to get down into a daily basis and look for what's going to happen in the week ahead. So with the ECB, what you got to look at is fundamentally we know that as far as an interest rate dynamic, what is the odds of anything that they're going to do? In the short run, probably not make a move for until, I would say, until we have the new Fed chairman. I could be wrong, anything can happen, but on a dynamic, usually when you have these transitions, other central banks typically won't make a move unless it's really in their economic plan when they have another central bank in a transition like that, especially one as big as the Fed for the U.S. So, and the expectations for the ECB is to raise a quarter point. So we have an expectations of a half a point cut total between now and the end of the year. They have a quarter point raise most likely before the fall. Okay, so that's a dynamic where we have anywhere between a quarter to 3/4 of a point difference, differential in the interest rates. Okay, that fundamental would be either dollar weakness or dollar strength, meaning that if the ECB was to raise for, let's say, tomorrow on Monday or in the next couple of weeks, that would be dollar weakness. That would put pressure on the dollar, which would give the bulls a chance to go and maybe challenge these highs for sure, let alone if they were to raise rates to take these highs out. There's a good chance that the euro is going to be trading around 125 to even 128 sometime in the next 6 months. Okay, so that's a good thing as far as knowing, because that's a 10 handle move, upwards of a 10 handle move to the upside. What's the downside potential? Downside potential is probably coming back to these lows that we had back in November in the fall. Why is that? Because one, with the dynamic, this with the if they don't change the interest rate in the euro with the ECB, this is about as low as you're going to get, especially because we are likely going to cut. So cutting would mean dollar weakness also, which would give the bulls a reason to challenge these highs. Okay. The only way that we would probably take out these lows from November, and this is key to knowing your trend dynamics, knowing that this is a very solid low, long-term, monthly basis. So where are we going? Well, if this trend is going to remain a bull or a range trade, it's going to be in a range trade too higher, buffering the upper part of the range. So we probably now are basing, is what I'm saying. Okay, so this is a good area where you look at it. Here we had this top. Okay, we fell back, we found this big boom. This is what this Japanese candlestick pattern catapults us up to new highs. Okay, so here was your zero line, here's your wave one, Here's reaction. Now you want to trade the action. Boom, what a rocket to lift off that one. Off to your wave 3. Now we pull back a little consolidation. This is our 4. We're probably basing here. Now here's something you want to look at too, is what do we have forming here? Okay, range trade potential. You know what also we have? We may have a potential head and shoulder, reverse head and shoulders. Here we have a shoulder for sure. We have a potential head right here. Okay, so I don't know if any of you guys are or not familiar with head and shoulders. Head and shoulders are very good classical bar charting patterns. Inverse head and shoulders is just exactly what the name implies. It's inverse. The head and shoulders normally is a rallying market. You have a shoulder, you retrace a little bit, then you have the action of the trend again, you peak at the head, then you have a correction again. That's a reactionary move in the long-term trend. Then you start to have an actionary move, you create another shoulder, it fails to take out the head, reverses, and then you have a reversal in trend, excuse me. All right, now let's just say that this is right, okay? Here we have this downward sloping trend line here. We know by attrition this is wedging, it's going to break out. So, good chance that we might challenge resistance early in the week. I would say with this close that we had on Friday, we had an inside day. So let's go down to the hourly. All right, now we're getting into something here. Look at this. So here was the low of 117.65 with a high of 118.29. So that's a 60, basically a 60 pip range that it traded in from Tuesday with the high on Wednesday. So between Tuesday and Wednesday, 65 pip range. That's on an hourly basis, okay, and a daily basis. That's not a lot to work with, okay? You got to think about your risk reward. I always like to, depending on the trading signal, if it's intraday, I go for, well, at the very least 1.5, and that's only if I'm in for a very fast trade where I don't know if it's, especially if it's going against the overall daily trend. If I'm taking a counter trend trade, then there's a lot of times I'll take profit at 1.5 if it hits it already, and especially once it hits the halfway mark towards a target, I'll put my break-even stop in much earlier than I might if I'm going for a 2-to-1 ratio, and depending on the market environment. So for instance, like, since we're kind of bullish the euro US dollar right now, because of why? Dollar index is sideways, under pressure, potential Fed weakness for the causing weakness to the dollar, as well as other action with the other central bank. Remember, when you're looking at a currency pair, look at both sides. You have this, in this case, you have the euro, and then on the other side, you have the US dollar. So that is the ECB and the Fed. So we have that fundamental dynamic, which means that no matter what, on a longer term basis, on a weekly and monthly basis, we have to be pretty much range trade to higher, meaning bullish the euro versus the dollar, just because of that fundamental. Obviously, there's many other fundamentals at play, but those are some of the major. Interest rates are a function of currency pricing. So if you avoid paying attention to interest rate dynamics, well, you're definitely gonna, that's not helpful for a currency trader. If you pay attention to the interest rate dynamics, I can promise you, it's one of the best things you can do to, one, reduce your losses for sure. Okay, so we have the sideways environment on an hourly basis. Okay, so what does that mean? That means lower your expectations. So for instance, when you have a buy signal or a sell signal, be rational. If you're trading intraday, and that's no matter what, when you're intraday, you have to be very rational with your expectations. You don't look to make as much on a 5-minute or a 15-minute or even an hourly chart as you do when you're taking something off of a daily, weekly, or a monthly. If you're trying to just figure out when you're going to start to get in for a longer term trade with an intraday trade, that's a different story. But if you got to think about your time frames. Like, so for instance, when I start to think that things are going to get range bound, that's when I take into account where days where it's like, okay, I don't think there's going to be a lot of swing trade follow through. If there's not going to be a lot of follow through, then you got to be very careful about picking your points. You don't want to trade in the middle of the range. You want to definitely try to buy in, wait for buying in signals on the lower end of the range, or sell signals at the upper end of the range. So then you're fading the extremes, but that's because you're the conditions, okay? So you got to think about your market conditions. If you had a big volatile period, typically there's going to be a digestive period. Markets don't stay sideways forever, and they definitely don't swing crazy erratically every day, all day long. So you pay attention to these dynamics. So what does that mean? So we've been trading sideways for a week. We know that, especially, let's go back to the daily, and here's something you got to pay attention to. So our Fed meeting is going to be, if I remember right, it is the 16th and 17th. Excuse me, let me just check my calendar. It's a 2-day meeting for the Fed. It'll be Wednesday would be when the release is. So that would be March the where is it? Excuse me. There we go. Yeah, that would be the 17th. Okay, so let's put that on our chart. March, 17th and 18th. Okay, so right here. So here's our timeline right here. Once we get past this, we either have a rate cut or we don't. Once again, I said the expectations are probably going to be pretty tight. So if you go, here's this week, here's Friday, so here's that. So this one right here, once we get to, basically for the next week or so, like I said, this is when you're going to find your market action. So here we have this upside here. Odds are very good that we were going to probably challenge resistance here. Could we fall back on support? Yeah, obviously we could, but right now the trend is what? It's been very tight, but it's been trending higher. We've been making slowly higher swing highs and higher swing lows. So let's go with the trend on that one. All right, so let's get back to our hourly. All right, so once again, where are we at right now? Right now we're hovering below the last major swing high on the hourly chart. Here is a hourly trend line that goes with our daily right there. So that means our daily trend line here is a pretty good trend line. So we can remove this noise right here and rely on this daily one right here. So if we're challenging resistance in a range trade to higher environment, you would want to look to try and buy somewhere in this lower range here. All right, so where do we have the biggest support? So I draw these boxes a lot of times on the intraday charts, and people are like, where do you get these boxes from? Well, I'm going to show you where I get these boxes from. So here we had a bunch of swing lows that were all pretty much near each other. Here was the major one, and this one here is almost a doji candlestick right here. Okay, so this was a liquidity trap right here. This was, boom, you can see a lot of people were trying to buy in. They were squeezing out your week longs here, and then, but they couldn't really get an accelerated move here. This is where base of the market was basing, if you will. Okay, so we're going to take this high and this low for this here, and we know that this is pretty much a basing range. All right, so we pull that out. Okay, let's make this a darker color so you can kind of see it better. All right, there we go. We got this blue. All right, so you can see here we took this swing low. Here we had a liquidity trap, basically range trading in this area, really skittish. And look at how the ranges were in here. You didn't want to trade in this area whatsoever. But trying to buy near this blue line here, or somewhere in the midpoint here, using somewhere around just a little bit below here as your risk, now that's not so bad. Now think about this. We bottomed here. See how it was chopping here? See how this oscillator was, this was pretty useless. In fact, it was very, very useless pretty much until we got to this move right here. And then we have a major trend move, a lot of volatility. This is where you gotta be careful, folks. Lagging indicators, the closer you get down in the time frames, the more noise you have with market action, okay? So you have a lot of algo spikes, you have a lot of liquidity traps, where on a daily basis they do happen, but they always happen during the day sometime, and it's usually the lower time frame you get, that's when you have to start paying attention to rational expectations, buying into dips and selling into rallies depending on the trend, and with the expectations. All right, so now why do we do this also? Okay, so let's just say that whatever your signal is, if you're trading anywhere above here in this area here, well, unless you were long here and got out real quick here, you probably held it, chopped, got stopped out. Okay, odds are pretty good that you didn't buy it here and have this all the way down here as your risk to absorb this swing before you could possibly get out here. And if you were risking from here to here, odds are pretty good you would not have gotten out here. Odds are, okay, just because of your risk reward. If you were, that means you're probably risking 2 to make 1. I know people do that. You're not going to, over time, you're going to lose money unless you're correct literally 90% of the time, and even still then you're not going to make very much money. Okay, so here, let's back to where we got the support zone. So how do you trade this support zone? Okay, so on an hourly basis, we know that here we had this downtrend here. Boom, look at this. Here's where it just first starts to turn green. This is where we had this liquidity trap. We have the swing low. Here, this is really not an easy indicator to get on as far as a trend. With this, it's showing range trade most likely. And that was good advice here. This is not where you wanted to buy it. Here now we start to see this start sloping upwards with the green. Now that's big, because then when the market is above it, think about equilibrium. It spikes up, it's got to come down. We want to get the ride that comes below this line and then goes up. Now here's where we get this. Now think about, this is a good one here. We have this swing low and this swing low here. This actually is lower than here. It's hard to see, but this actually slopes down slightly. Okay, now the thing here which is nice to look at is, here's this low here, here's your flat line, and then here is this. See how this market is coming down here? It gets really volatile. Okay, the market here, it broke out, real good swing trade, then it crossed. You're like, oh, is this going to go back to the bear trend? It gets kind of messy right here. Then it starts to open up right here. And that's where this gets big. That's where you know, like, this was a good area to buy in. So we had, here was where it starts. You have your first draw. Here's your second draw. Very muddled indicators. This first started to come in. So now this is sloping up. When it dips down here, this is when you start to look to try and find a buying area. Okay, so that would be when this is coming here, like this market's breaking, this market comes in here, that's where you would be looking the next day, like right in there. So somewhere in this center mark here would be where you would be looking to buy. Okay, now this would be if you're trading the hourly basis. Now think about this. Okay, let's just say that you put this trade on. Okay, this is where I want to get you guys on the right tone, like 1 hour versus a 5-minute trader. Okay, if you're trading the hour, your expectation is here. Let's just say, boom, you're like, okay, Teddy, we're going this. We're not going to jump in on the first turn or potential turn here. We're going to wait for a really put the odds in your favor. Like here, we know support once, twice, 3 times. This is the 4th time where, but here, look at where it was making lower move lows, lower move highs. What did it do here? Lower move low, lower move high, higher move low, higher move high. Okay, your trend dynamics are already telling you when you're making a higher move high and a higher move low, you're going up, you're not going down. Trade the action, not the reaction. So you're not looking to sell when you're going from a higher move low to a higher move high. You're looking to buy a higher move low somewhere in that area. Okay, because that's your biggest odds of trading the trend, because then you're not trying to sell that reaction and then try and figure out, oh, I gotta, what am I looking, how much is there to the downside in an uptrend? not much, okay? So you want to look for that buying area. Here you go. You come back into our box zone, so that would be your midpoint. Okay, so let's just put a midpoint line here, and we'll make that color purple, and we'll make it solid. Okay, so here's our solid line, and then look at what happened. Remember, where support becomes resistance, resistance becomes support. Well, this is obviously very solid support. On an hourly basis, we came back down here. We'll get to that in a moment. So here's our upside bias here. We have our trend move. So how would you trade this? Well, okay, this time it's coming in. You would have probably had your order in right on the midpoint. So we'll just put it right there. Your risk, now you want to be, oops, that's the indicator there. You want to have a 2-to-1 risk. Now, so here's your swing low right here. So you want to be, this was our solid low. So let's see, we already know it's the liquidity trap zone. This is where if you're going to get, in theory right now, is if you're going to be long, be careful, because big money is going to try and drill you out, spike you out, stop you out, because they know you're a week long, and then as soon, you ever wonder why you just get stopped out, and then all of a sudden, boom, the market reverses and goes to your target? This is why, because you're in an area like this. Okay, plus you got the muddled indicator. So you put, here's your low here, which was 1766. All right, well, you're definitely going to go at least down to 1760. All right, because 3 or 4 pips, you know, no matter what, you're on the bid offer, you're going to get stopped out. So you want to at least put it down to 6. I would say go down actually to 60. Okay, so putting that at 60 from the entry point, so where does that put our target? So we already know we're long at a price of 117.73. Okay, 117.73. We go to 2, a 2-to-1 ratio. Look at that. So on this break here, you're coming in, you put your risk on. Look at that. How long does it take to catch that move? It doesn't even go to take out this swing high. That's a nice solid trade right there on an hourly basis. Now break it down into a 15-minute, and let's see what happened. So here's our 15-minute. Okay, 15-minute, the market was sliding down. At that point, remember, we had the big top. Okay, it's obviously spread out now because it's a 15-minute chart. Look at this. Market here, boom, we had our indicator. It's moving here, nice top, nice smooth. This is a bear, bear, bear. Boom, it comes down right into our buying thing. We're fading the correction, but we're going with the overall trend. We're buying into weakness here around old support, right? And you can see, look at how this was the draw. If you right at the top of our zone, remember the blue, the light blue line, we'll make this solid so you can see it better, that little box. So you remember, here's the midpoint. Right when we came to the top of that, remember, that's where that area was for the range. Look at this. Market did real tight, did a little doji there, like it almost wanted to bottom, then boom, here's your liquidity draw right here. Boom. That's big money drawn, just bam, like look at that spike. If you're trading this, I guarantee you on the 15-minute when this happened, most people, what do? They start selling. They start selling right here, and then right here you get this nice little positive thing, and it's bouncing here, and all the sellers like, oh yeah, we're selling into these lows. Look at how the momentum right here, and then boom, what happens? They get stopped out right here. All right, big money's buying it up. Then boom, you get all the people saying, oh no, we got to get back on the trend. Boom, here comes the other liquidity snap here. See how it does this? 3 red bars. Look at this, really strong to the downside. Then now, boom, here we go slowly with the indicator. So here, the indicator didn't turn right here. Boom, we get the snaps up here. Oh, it turned, like, oh yeah, here's the trend. It gets a little choppy, and then boom, here's the confirmation when it breaches out here. That's a good trading area right here. Very low risk with a high reward. Now that's 2-to-1 right there. Obviously, you can see that this went higher, but this is, now look at it. How much higher did it go? Okay, so you could have gone, let's say, to, this is a total of almost 4-to-1, but that's the extreme, okay? Let's say you went to 3-to-1. does that put you? It puts you right about there. Okay, so it puts you right before this area here. Now this is a major resistance there. This would have been, I mean, obviously it did go higher and it did hit a 3-to-1, but that's pretty much your extreme. Remember, you're on an intraday basis. This is now a 15-minute chart. We started with the hourly, but it's still an intraday trade. It's not a daily trade, okay? So what does that mean? Expectations. You don't go for the 3 to 4 to 1 trade, okay? Now, if you were looking as a daily basis to get in on an intraday and try and buy it down that way, that's a totally different story, because then you're looking to probably make 20 to 1, okay? So that's a totally different story, okay? But then your stop here would be much wider. You wouldn't be risking 6 pips to make, 12. They're actually 13 in this case. You'd be risking, and probably in that case, something like 15 to 20 to make somewhere around 100 to 150. At least that's what I would do if you're going to try and trade that dynamic. Because especially as far as making your money over time, that's what you need to do. All right, so here we go with the 15-minute. You see how that worked for that time frame. Now let's go down to the 5. So remember, you started with an hourly basis, and you're like, well, okay, so now I'm in this trade. Let's see how it looks. All right, so now it's even wider. Here was our initial top that we fell down from, okay, on the hourly. Now it's spread out even more because it's a 5-minute, and this is where your rational expectations have to get. Now remember the 2 to 1? 2 to 1, remember, it hit just at 4 to 1 overall, and that was the extreme. 3 to 1 was already kind of rough on that, okay? And that was spreading. Now remember, that's spreading time frame out. This is a 5-minute chart. Looks like a lot of time. You compress on the 15-minute, but it's still a lot of time passes. 15 minutes, times 4 is an hour, times 24 is a day. So your 5 minutes, if you're in a 5-minute trade and it's a half a day later, or you're pushing 24 hours, you're not in a 5-minute trade. Okay, so remember that. That's why. What are your expectations? What are you gonna? And the longer you're on it, the less likely you're going to hit. Okay, just on an expectation basis, be like, okay, you're wrong. Okay, you were trying to be a bull, and it's obviously being bearish. Okay, so here we have. You're at the 3 to 1, so you're at the caps out here. Now look at this. Here you had your trend. Once again, your indicator for here, boom, boom, boom. You don't want to use this. It finally gets your cross. That's when you get your initial bounce before, boom, it collapses. Here's your wave 2. Remember, market's going wave. Here's your 0. Here's your true bottom. Here's your wave 1. Here's your reaction wave. You don't want to trade this one, okay? You're already in it already because you bought into the zone. But this is where you know you're secure. Once it comes in here and this takes out this, you're like, okay, shabam, here was our 0, 1, 2. We're going into our 3 to hit our profit target. But this is a 3 to 1. Now on a 5-minute, you go back down to 2. Oh, look at that. Oops. Okay. You're out right there. Okay, so how long did that trade take? Remember, you started with an hourly trade. You had your limit in. You bought into this. You weren't trading the reaction. You were looking to trade the buy down the action, so you could get into the action trade. Put the odds in your favor, trading on the side of the trend. Okay, so this trade came in. And it was initiated right here. This would be at 5:25 Central Standard Time in the morning. So that's basically 2 hours before the interest rate markets open up. And boom, here's what happens. Oh yeah, interest rate markets open up. It's traded here. Then all of a sudden they open up right before they start pulling back interest rates. Then the stock market opens up. And then boom, there's your trade. So by 9:15. Okay, so less than 4 hours, just inside 4 hours, you would have hit this trade. So that's a trade from 117.73 up to 118.01. So you do the math there, that's 28 pips. 28 pips in 4 hours, it's 7 pips an hour on an intraday trade. Okay. Now, if you were in that trade, remember we go back to our hour. only a few hours involved in the market. Did the market go higher? Absolutely. Intraday trade, okay? So for the intraday trade, boom, that's where you wanted to be. That's also where you wanted to get out too, okay? So, I mean, obviously you look at this on an hour, they're like, oh, geez, we could, if we would have held out, but then, okay, remember, look at where it went. It was chopping around for another 1, 2, 3, 4, 5, 6 hours. Now you're heading into the stock market's close, afternoon markets. Here's your blow off rally. This is that noise that happens when the markets close. Okay, it's thin volume. Is there opportunity there? Absolutely. Would I say that you want to trade it? Okay, well, this is when we get to candlesticks again. Candlesticks you want to use on the hourly basis up. You don't want to use them below the hourly time frame. Okay, so this would be one where, okay, we had our buy signal. You wanted to be out of this noise, because the longer you're going through here, remember you're trading a 5-minute chart. Okay, would you rather make your money in less than 4 hours, or have it on for an extra 4 to 5 hours where you may make some more money, or it pulls back? I mean, obviously this was pushing the upper boundary where it started pulling back. It could have came back. Actually, it came all the way back to where you bought this. Okay, would you like to have look if you're going for like a 5 to 1 risk reward ratio? Once again, on a smaller time frame, you would have held it and absorbed it in this chop, and then running around, you'd be like, oh geez, I should have taken profit. Then it comes back up again here. Now it's making a lower high. Oh, I should have taken profit. I didn't take profit. So don't drive yourself mad, because that's exactly what you're going to do. It also means you're being subjective. You don't have a plan. You should have a plan for a short minute time frame. You should have a plan for a long minute time frame. Okay. So, what would you rather do? Be right all the time? Well, it's not going to happen. Or would you rather be right where you're putting the odds in your favor, you're putting the highest profitable factor also in your favor, okay? Versus being greedy. You know, if you're going to try and buy the low and sell the high, please keep doing that, because I've been making a living off of people like you my whole life. That's what people like I thrive on. It's what the institutions thrive on, is traders who you are the weak longs and the weak shorts. We love to prey on you because of making mistakes. It's bad habits. It doesn't make you a bad person. It just means you're making a mistake. Think about it like this. I don't know if any of you play poker, but poker also, it is a game, but it's also actually a business. How do you make money as a poker player? It's not necessarily just having the cards. Obviously you need cards, and you have to play the player, but the main thing is not making mistakes. The more mistakes you make in poker, the more capital you're going to throw away. So even if you're making money as a poker player, if you're doing a lot of consistent mistakes, you're definitely not making as much as you should. And you're also putting yourself into a higher risk factor, because eventually you're going to have streaks that go against you. You're going to have bad days. You're going to have losses. If you think that you're going to make money every single day, well, good luck with that one. I don't know anyone that's in the trading business that ever can say that they have. All right, so here we go. Once again, on the hourly, look at the expectations. Okay, this is carried over for multiple days. It came back to give us another chance to buy here. Okay, and this once again puts us back to the hour. So we took the 5-minute trade. We know that's off. So would you be looking for a trade right away? Well, no, you shouldn't be, because what happened here? Our trade got hit. The indicator crossed. We don't know at this point. Is it going to challenge us high? Is it not? Well, it did. It went sideways chop. We don't want to be involved in this part here. Okay? I mean, let's go back down to the 5-minute. Let's go back to where we made our money. And this is where this is a lesson. If you haven't figured it out, I'm trying to teach you right now to not over trade. If you haven't figured that out, that's what I'm doing here. So let's just say that you did keep it on, right? So here's where we were. We were at 1801 to there to 1828. So that's a 27 pip range what in the world would you be trying to do with a 27 pip range? Honestly, that's like trying to trade Christmas Eve and make money. Now, can you make money at 27 pip range? Yeah, if you maybe bought the lower extreme by a couple pips or sold in a couple extreme, but that's not happening. I mean, maybe you pick it off once, maybe, or twice, but on a daily basis, if you're trying to do that, or if you think that's going to happen, it's not, okay? It's just not, and there's nothing there. There's no risk reward there whatsoever, okay? So you don't want to trade that. However, it would be nice that once the trend shifts that you get into another trade. So what do? 5 minute, you don't use the 5 minute to get in. You got to have your trend analysis. Remember, where was our trend? We were looking to buy into that trend, remember? So, because before we're like, okay, it's an uptrend. We were looking to buy the dip. That's what we did. We bought a high probable dip. So now here we go back to the hourly. Here we go, boom, boom, boom. It's railing, it's railing. Oh, look, it's coming up towards this area here. What do you know? What do you know about that? So here's another. Remember those boxes that we did? Okay, remember we drew the box with the hourly right there? Well, here's another box for you. Here was this big extreme high here. So we'll take this and we'll go down to the second day there. And we're going to come right along. Oh, look at what that falls into. All right, so now, remember we want to trade the action, not the reaction. So do we want to sell into a upward trending market? No, we don't. Now we're almost, we're just over to 10, 1 hour, guys. I'll still hang on we're going to finish this up. If you guys want to stay another 15 minutes, I can even do a half an hour. If you want a half an hour, type it in the chat. If you want 15, we'll wrap this up. I'm going to show you how 2 more trades and set you up for the week ahead with the euro. Okay, so when we got out of that one, now we're looking once again, okay, well, we're in a bullish forecast. We want to look to buy again. So where are we going to look to buy again? Well, that would be definitely in this zone, but we're up here. So we're not going to try and buy it up here. We just got out of the trade. We definitely don't want to try and buy it up here. We're buying into highs, not that you don't want to buy into highs, but this is an intraday, not a daily or a weekly. We're looking for a long-term trend breakout with big risk. So we're okay, so where are we going to buy? We're not going to look to buy in here, but hey, where do we look for a potential turn to then look to buy off of? Okay, so here we have this one. We come into this area here. Now, ironically, it actually fit right in the middle of here. You could have sold the middle of this box here, right on this at the beginning or into the middle, and taken this trade here. But here, you're going against the indicator. This indicator is bullish. It's trending up. We have the trend dynamics going up. This indicator is going up. Everything is saying up, 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 right? Okay, so now you can put in this, obviously. And then what happens? Well, we know by attrition you're going to fall through that. You had a nice steep rally. What do you have here? You have a Japanese candlestick pattern. Okay, this is one of my favorites. Oops. Okay, this top right here. So here we have a bearish engulfing line, just like we had the bullish engulfing line that was back here. Remember, we had this bullish engulfing line that set our base off of right here that we bought into. Here's our selling bearish engulfing line. So that's a big sell signal. So this would be a situation where if you were trading here at night, this would be when the Asian session's already in full swing and it's a couple hours before the European session opens up. This is when you do have some activity in the euro and especially the yen and stuff like that and the pound. This would be like, okay, well, this is below this high. This was a high area here. Resistance, is it still resistance? Could be. Remember, we've been in a range trade type of environment for days. So if you were to fade, the trend is range trade to higher. So we're actually looking to buy a dip. This would be a relatively low risk trade. Now here's where we get back to expectations. So let's say you're trying to trade the range trade. So this would be a situation where at the end of this bar, you would sell it. Okay? So where would our risk be? We know here's our high here would be 118.34, so we're going to go up to 118.40. We want to have every bit of a 6 pip. It's intraday. You don't want 3 or 4, but you don't want too extreme. And since you're going counter trend, it's better to lose 6 pips than to lose 10 or 15 on a trade that's it's just going you're selling that into momentum. Okay, remember we're fading that. So here let's go to our 2, and what don't we hit? Market doesn't hit it. Here it's boom, 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 and look at that. It doesn't ever hit. So what does that mean? Because you took, now this is where you got to think. Why has Teddy been getting you to this point? Okay, you're taking a counter trend. You're trying to trade the reaction, not the action. Okay, don't do that. You have 2 indicators. You can have other indicators. I just have these up there. That's the MACD and also the multi-kernel regression. Everything is screaming going up. You're going the opposite way. Now, if you want to be Superman and jump in front of a freight train, that's pretty cool, but I hope you're Superman because he could do that and stop the freight train. I don't know about you. I'm not Superman. I don't jump in front of freight trains. I know that that's not going to work out well for me. I would rather ride the wave. So here's one where, okay, remember I said lower your expectations. If I'm going to take a trade like this, I'm not going for the 2 to 1 because no matter what, once it gets halfway there, I got to put a break-even stop in, which means odds are I'll have a couple pips of break-even plus a couple pips. It's going to end up I'm only going to make a couple pips. So yeah, but then now you think about what did I make? I was risking an amount of money to make 2 to 1 initially, and I end up, if I only make a couple pips, you don't lose money, but you went out and start trying to make a 2 to 1 ratio, and you're actually, when you close it out, you're like, well, wait a minute, I only made, I know it was more like a 1 to 6 ratio against me on what you actually had at risk initially versus what you made. Still profitable, not a loss, but you're putting yourself at risk. It's better not to even have that money at risk, just better. Interested to hear your sell on Thursday. That was, Thursday we did have the one sell trade. And so anyhow, with this one, remember at the beginning of the webinar, I said if you go in a counter trend trade, 1.5 would be pretty much the extreme. Well, look at that. Rational expectations. Now, if you're not going to be greedy and you're going to go in a counter trend situation, boom, you get this. That's all you had. And also think about this. This also happened on Thursday, and you're heading into Friday. Okay? And when you think about that dynamic here, here's Thursday. You know that boom, 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 no matter what, this is an hourly trade setup. Okay? You're trading 5 minutes, you're looking to trade for a few hours to half a day. On an hourly trade setup, then you're not just trading a few hours. You could be trading for a day and a half. Okay? Day and a half, if you're trading on a Thursday early morning or Thursday afternoon, or Thursday early morning, meaning like 1 o'clock, 2 o'clock in the morning, or once the market's open in the U.S., well, then you only have a day and a half of actual trading, where the last few hours is definitely the end of the week. You could trend, it could be tight like it did here, and also your expectations of the end of the week. You got to figure come Friday, there's no numbers, which we didn't have. You're going to get compressed trading. Your ability to pull off whatever trade you are in decreases. Follow through. Okay, there's not any follow through you were initially looking for. You're not going to get, especially on a reactionary trade like this. Okay, so you're like, okay, Teddy, we took this one. This would be a trade I would say. If you are just starting out as a trader, take these trades. Stay away from these trades. Don't take these trades. If you do, reduce your expectations and be rational for these setups, okay? Now, once again, what happens here, let's say you took this buy back in this area here. This is, once again, we made here these lows, higher move high, higher move low, higher move high. Is this going to be a higher move low? Well, we have this nice, this is actually a Japanese candlestick pattern right here. This is another one that I'm not going to get into because we're going to keep on going with this one here to wrap things up. So here we're going to look at, this would be our long again, buying scenario, and we know that we're coming towards the end of the week because this is Thursday and this is at noon, this trade. So here we would be, we start out, here was the low we just came off of. We know here was the low before. We want to definitely go, we know that this was, we played this before. We don't need to go as extreme, but let's do it. So we put it right there, and then we put it to 2 to 1, and we know that it would be up there. Now it follows, we don't get that far, but here's what we do. Coming into the week, I believe that one of the people in the chat room here that's watching is someone who I've been in some communication over the past week or two. Good question was, do you trade, leave a position on going in over the weekend? For most new traders, I would say one of the worst things you could do is stay in a position over the weekend. So this is one where, okay, the market closes at, this is Friday, okay, in the afternoon. I usually will get out by somewhere between 12 o'clock and 1:30 Chicago time, which is Central Standard Time. There's still another couple hours left of the market being open. The U.S. stock market doesn't close until 3 o'clock. Cash market, that is, S&P is closed at 3:15. But the closer you get to those winding down hours, especially after 2 p.m. Central Standard Time when the interest rates close, you're going to see the currencies, the spreads start to, well, the one, liquidity starts to dry up as well as the spreads start to get worse. You don't want to be giving up. All of a sudden you're like, okay, well, you're almost at where I wanted to get to, but to get out, I gotta get out here. So it's like you could have gotten out of your trade like 2 hours earlier at the same price or better than you would when you're getting towards the end of the day. Plus, you could have a very quick liquidity draw at the end of the day where you're sitting on boom, 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 boom. Like you can see how this is towards the end of the day. One last chop up here, then it dies. Anyone that was in this here that was a week long, they got stopped out, they got squeezed, okay? Here, you bought into a smart area, okay? And here's another thing. Here was our trend. Okay, once you breached this downward sloping resistance line, you know you're by attrition, you're breaking through it. You had your higher move low, you're trying to head towards a higher move high, but you're running out of time. You're running out of time, okay? So no matter what, sometime between, once you get into this part of the day, okay, here's Thursday, now you're into Friday, okay, once you get towards the end of the day, this is when you got to get out. Here's 11 a.m., here's 12, here's 1, here's 2, here's 3, okay, 3 o'clock you're closed. Look at where you could have gotten out 4 hours, 5 hours earlier at the same price. Why would you have the risk on, especially going into the close? Anything could have happened. Could it have gone up to your target? Absolutely. But and you're almost at your target. Why would you not get out at this time? Okay. Rational expectations would be that, once again, here we go. Here's 11 o'clock. Here's 12 o'clock. Boom. Get out. Take your money and run. There you go. Okay. And then you look at it like, okay, well, if I got out there, oh shit, I could have gotten out there at noon. There's another thing too, is once you get past noon, you get this momentum. A lot of momentum fades. Look at, you came back, you chopped in, it was basically coming back almost to where you bought in, and then boom, it comes back up here. So rational expectations would be, yeah, by noon, take out your trade. Did you hit exactly to where you were? No, but this is a trade, once again, that goes with your scenario. So here's a trade that you initiated on Wednesday. Here's one that you would be initiated on Thursday, okay, at night, right at the beginning of Friday morning, or excuse me, right at the beginning of Thursday morning, okay. 2 good trades where you would have had how many hours involved here? Now let's go back to the 5-minute. There's the 5 minute. Okay, so here we bought into that zone. You can see where it was trading around here. Our expectations were actually a little bit higher than that over there, but for our time frame, and look at what happened. Once we actually had this initial blast, you can see, boom, towards the end of the week, dying out. Where's the trade there? There's not much VIG for the whatsoever. Most of this time, it was barely above your buying price. This average area, that's the way to play it, okay, on the time frame like that. These are, once again, having rational expectations for your time frame, okay? Because remember, we were trading hourly, not daily, okay? Now what I'm going to do is I'm going to give you guys a couple of links real quick. So I mentioned Japanese candlestick patterns. If you want to learn how to trade these properly, yours truly wrote a book on it. So on my website, on forex-trading-unlock.com, there's a web page here that has access to a little bit of the book. You can read a little excerpt from it, and it also has a link. Obviously, you can buy the book. It's in Kindle version, paperback, and hardcover was just put into motion this week. I don't know for sure if they have that one available yet. Let me see. We'll go right now. I'll go on the thing. I don't think it happened yet, but this is something I want to know. So for you guys that are out there, no, the hardcover is not available yet. That's coming out. Just released that. So what I am going to do is have a free Kindle promotion for my book coming up. So for those of you that watch the stream, pay attention for that. It'll probably be in a few weeks. I got some other things coming out, but I do a release where if you are a Kindle or I think Amazon Prime member, you can read my book on Kindle version for free. You don't get to keep it, but you do get to have access for it for free for I think 30 days is what it's not. It's for a month. So I didn't want to do it this month because of February, because of the shortened days. I figured I'd rather wait until sometime in March or April or May to do it, where you can get a at least a few extra days. And then if you like the free version, you can always buy it and keep it in perpetuity. I would prefer you buy the paperback or the upcoming hardcover, but that's me. I like books anyhow, solid books. So anyhow, that was a good session here for what was going on with that. Now let's get us for the last closure here is for what are we going to do in the week ahead. They're like, okay, Teddy, so we look at these trades in the past, we learned some dynamics, so where are we? Okay, well, let's go back to where we were before. So let's go to our daily once again. Okay, so daily we know we're sideways to higher. We're looking for the breakout to the upside. We'll go back to our hourly. Now, the market's going to have to open up on Sunday, and we'll see. Usually, Sunday nights, you got to be careful with what's going on. One thing I would really say that's really important is that you should go to always make sure you check the calendar. I'm going to put this link here. So this is our workstation page on forex-trading-unlock.com. When you pull up the workstation page, the first thing they have is a calendar. So for the week ahead, March 2nd, we look at the Euro US dollar. So we have a retail sales comes out for Germany at 1 a.m. So that could get a little jumpiness. So it's another reason why you want to be out on a Friday on a chart like this. Here you got a nice lead on a trade. You got retail sales coming out at 1 a.m. The market could open up higher, lower, whatever. Could gap one way or another. It could gap through your stop. Okay, so that's something you don't want to have happen where you're on an intraday trade like this. Once again, rational expectations. You want to be out. Now, if you were in a daily, weekly, monthly trade where you have bigger risks, that's for more long-term traders with a lot more experience and bigger pockets, bigger expectations, bigger risk, etc. We're not talking about that today. So our trade right now, his mindset is we're looking for Friday or Monday to come in with a buy break mentality. We're looking to be range trade to higher with definitely the expectations of a bullish breach rally, not okay. Markets break out to the downside and they break out to the upside. They do not break up. They rally up. I hear this all the time from people in the industry on the talking heads and news. Markets break down, they rally up. They can break out to the upside or the downside, but they cannot break up. You got to know what direction you're going. Right is this way, left is that way. From my perspective, it's like up is down, that's a rally. Breaking is going down. So, all right, so we're looking for the buy break scenario. We already have our zone right here. We have these last two buys. So I would say that you want to look somewhere between this area right here. So this last swing low was at 117.73. So 117.75 basically down to 117.5. I would say in that 25 pip area. If the market retreats down there, that's probably a very good area for it to go to. So let me put this in array. So here's 117. 71. Okay, 75. And let's make this really thick. Okay, so 117.75, and we're just going to put this down to 117.60 right there. All right, so we have the blue zone here. Now you could have it this midline in our blue zone. See at 117, basically 117.70. That's a good buying area. I still like it more down towards 117.5. Obviously a lot of support base there. I would say if the market does trend down into that starting out, especially with that number, and we have a 9 o'clock ISM number coming out. There's a Japanese yen number coming out. There's a lot of numbers on Monday between 1 o'clock and 9 o'clock our time that could cause a lot of volatility. I would say the best time to trade the Euro US dollar would be to wait until probably after the retail sales in Germany are let out. That's at 1 a.m. Central Standard Time. I will wait till like 2 or 3, give it a couple hours, see where things are. If it's trading up in this area, around this area here, not really a good area. I mean, there's support, probably gonna get a liquidity draw down here. I would look to buy it somewhere in this area here. Oops, wrong one. We don't want we want the ellipse here. So somewhere between here and here, right in this area here. This is where I'm looking right here. So if you slip down past this is a major trend line here. This is not an hourly, this is a daily trend line. So this is big. This would be a good area for a liquidity draw. Remember, big money, if the institutions, if we're right with our forecast that we're in a range trade to higher situation, this should be the floor. This should be an extreme area right here. Could it market bottom in here and rally? Absolutely. Do you want to be a buyer in there? Right now with the expectations, the numbers that are coming out on Monday, okay, you have those, and then we don't have another number for the U.S. until the 4th, which is when we have ADP, national employment. We have PMI that comes out with the ISM PMI number also. Those are coming out on the 4th, and then the 5th we have jobless claims. So nothing until Wednesday and Thursday. So be very mindful of that as we go from Sunday night into Tuesday. There's only that little speed bump of time. So I would say wait, because you're most likely it could just be a chop zone fest until Tuesday, where we might be in a range trade in this area here. Remember, this is an hourly chart going. I mean, could be 2 days. Where do you want to trade in this nonsense here? You don't have much to work with here. I would rather look to buy in this zone here for sure. If you're going to fade this area here, be mindful of where we had this sell here. I would look to sell it above this zone, where if you get to, let's say you pop above here, okay, and then you get make this sense. I'm going to draw this so you can see this. So let's say the market gets up above here, and then it closes right in here. Okay, if you get something like this and you get a close, then maybe you could have a sell where, and now I'd be, if you're, this is a counter trend also, remember, counter trend trade, if you're going to trade something like this, wait for it to breach, make a new high, settle below here. Once you get a close below here, and then wherever this high is, I would keep it very tight, very, very tight. And then once again, if you're going to do it, and this is why I would say be very cautious of this trade. Let's say you get something like that. Where are you looking for it to go? You're looking for it to come into the middle of this range at the most. Okay, then you're no longer looking to buy into here. If this was a trend trade, you would be looking actually to sell it and take profit here, which would be a great place to reverse. But now we don't know. You're going once again against the action. You're trading the reaction. Okay, I don't want you chopping yourself up to start the week off. That's not the way you want to do it. Okay, so very good day today with you guys. I'm really happy that you guys stuck it out with us for an hour and a half. I gave you that link for TradingView. I gave you that link for my book, High Probable Japanese Candlestick Patterns. And I have one more link for you also I'd like you to take a look at if you get a chance, is to, if you haven't already done so, I have a newsletter that comes out. This is one that there's a 30-day money-back guarantee on it on this one. And then we also have one that is free, no matter what. So I'm going to give you that one right now. So you got Tiger Forex Report right there. That's a newsletter that costs $97 a month. 30-day money-back guarantee on the first month. If you don't like it, then I have this one, which is free. Check that one out. That's through our website. And you can also go to our LinkedIn company page as well. We have one through LinkedIn. That's another good newsletter. That one, but that one I don't put out as often. That's something I use for more for institutional traders, but I do have a lot of retail traders on that list as well. The one from the website is more geared towards the retail traders. But anyhow, great session with you guys. You guys have a wonderful weekend. Look for that buying area, like I said, on Monday going into after the numbers. I would say wait until after 9 a.m. There'll probably be a good chance to catch a trade from mid-morning Monday going into Tuesday, probably buying in that lower region. Be careful if you're going to take a counter trend sell trade, all right? So I want to thank you once again. You guys have a great one, and always make sure you got a trading plan. We'll have some other further webinars for you guys, and yeah, you take care.